One of the things that needs to be established in your trading plan, beyond what your actual chart analysis and strategy steps are, is what position size that you take when you place trades. Now, a position size is basically how much of your live trading account are you going to put at risk with every trade. That is your position sizing. You cannot decide your position size based on how much you want to make. We know you want to make tons of money. That's why you're going into this. You have to learn to focus on how much you're willing to lose. Always position your mindset on how much you're willing to pay or spend for that trade. You also cannot decide your position size and place trades based on how lucky you feel at the moment. You want to trade a consistent percentage of your live account each time you enter the market, and you do not want to deviate from that amount, except maybe as tested out in your strategy. If you find, a certain setup has a higher chance at profitability, you then might trade a higher percentage or an alternate percentage. But you want to find that edge in the market and execute without feeling emotion over and over and over again. And you certainly do not ever need to determine your position size and place trades based on your most recent winning streak or your most recent losing streak. You will again end up changing your trading size based on your emotions. You'll be feeling lucky, and so you'll up your trade, to 5% of your account or 15% of your account or 30% of your account. And if you lose a 15% trade, you just undid your compounded profit of the last 1% trades by that one emotional gamble entry because you were feeling lucky. Also, if you're feeling gun shy because of losing streak that you maybe have gone to or you had some drawdown, you will trade that very minimum amount until you get your confidence back, and you'll miss some great profits in there. And so when you're feeling lucky, you do really large, percentages of your account, wiping out your profit that you've taken. And then when you're feeling, again, like, I've had some drawdown, I'm a little bit more fearful or a little bit more cautious, you take smaller accounts, and you cannot sustain profitability without being consistent. So that is why we are here in this lesson on how to figure out what a proper position size is. And I'm giving you the tools to really create a winning strategy, a strategy that is completely balanced and has everything that you need and more to build in to give you that market edge. Make sure that you have all the parts in place that I've given you here in Unit 6 of this course. Look at these parts one by one. Review your handbook time and again. Try different things. There are multiple parts of strategy building that I've given you, 5, 10 different options of ways to look at it and try different things. Try those things. Over the years of trading, hone the pieces of your strategy and don't get locked in on one way. Try different things with your strategy, but always keep in mind the different parts of your strategy and what parts we've gone over here, and often check in as to how the different parts of your strategy are performing and then tweak as necessary. Now, this will be necessary to do for what position size and what risk management you're using in your trading plan as well. At times, you may need to increase your position that you're trading, and sometimes you need to come down in size, especially if the amount of money that you're placing on each trade is causing you emotional distress or is making it so that you cannot execute, without massive spikes in self-protection or triggers or different things with your psychology just come down. And so there are times to really look at position sizing, but we're going to go over how to calculate this and what position sizing and risk management actually mean. Now, position size in risk management is a highly personal thing, and one trader has a completely different comfort level with risk, a different skill level with trading, a different relationship with money, and different mental and physical discipline when it comes to executing trades according to their trading plan rules, as well as even discipline to apply to a healthy life and mindset. So nobody is going to enter into trading or into position sizing and risk management, from the same spot. It is very personal. So let's take a look here at where to start. First off, you need to know and hear this: your position size is determined by the number of lots and the type and size of lot you buy or sell in a trade. Forex trades are measured in units, okay? And a standard lot here is 100,000 units, okay? And that's what you need to know. A standard lot is 100,000 units. A mini lot here is 10,000 units. You have micro lots that are 1,000 units and nano lots that are 100 units. And each one of those units has a volume and a pip amount. For the standard lot, you're trading about $10 per pip. On mini lots here, you have where you're placing about $1 a pip. Micro lots here are 10 cents a pip, and nano lots are about a penny a pip, and that's what you're trading. Your ideal position size is determined by dividing the money at risk or your account risk limit by your trade risk. Now look at this example. Let's break it down as to what that actually means. First, what you're going to do is you're going to take the balance of your account and figure out your total trade risk. Now, this is done by the amount of money that you're willing to risk in a trade, and that is usually figured as a percentage of your account. So in this example, we have a starting balance in our account of $10,000, and we're going to say that we're a smart trader, and so that we risk 1% of our account on every trade. Now remember that most successful traders only risk between 1 to 3% of their account, maybe up to 5% per trade. Back to this example here, again, we're smart traders, and so we are doing a 1% risk every time we crank out an entry to a trade. And so in this example, if we multiply this $10,000 starting balance, multiply that by this 1%, 0.01, we get a trade risk of $100. So 1% of this $10,000 starting balance is going to be $100. And we're saying I'm willing to risk 1%. I'm willing to buy this trade for $100. I'm willing to spend $100 on this trade. And so that is the amount that we are risking. That is the amount we're willing to place on this trade. Then you take your total trade risk, which we've already determined we're willing to pay here, $100. That's what we're willing to risk on each trade, $100. And you take that trade risk, 1% of your account balance, and you divide that right here by the number of pips that you are placing between your entry and your stop loss. So when you have a trade, let's say that is bullish, and you're going to enter right here, and you're going to place your stop loss here. In this example, what we are saying is that when we're ready to enter this trade, we have a 10 pip range here that we're placing. So our stop loss from our entry point to our stop loss is 10 pips. That is, in this example, what we're going to assume is our stop loss. And so we're dividing our $100 by our 10 pip stop loss. And what we come up with is that our per pip risk is $10. So we have determined now that we trade a $10 per pip risk. So on our $10,000 account example here, you would be trading one standard 100,000 unit lot for a $10 pip cost. So right here, that's what you see. So we have determined that it is $10 per pip. That's what we're spending. We have 100,000 units that we're going to put in our lot size when we place our trade, and that comes to $10 per pip risk. Now, you will have to do this every time you take a trade. However, if you're consistent on the size of trades you take and on the pair that you trade, you will know exactly how many units to put into your platform in order to reach your 1%. You're going to know, is that 17,000 units? Is it 1,700 units? Is it 400,000 units? And so everybody is going to be different depending on the size of your account, as well as the comfort level that you have of how much of that account you're willing to risk or willing to spend on each trade. And I highly recommend, especially if you're a new trader and if you trade several different pairs, that you just use a position size calculator. One of the sites that I love and actually have listed in my resources section of this course is babypips.com, and they have a position calculator that is simple and excellent. Now, TradingView also has a built-in calculator for position size if you're placing trades through their platform, which I've already said kind of is a sweet spot, or one of several sweet spots that's available for trading, that you can use there. Most trading platforms have some level of position calculation available, but honestly, like I said, once you're placing trades consistently, you'll just begin to know how many units your plan allows for your entry. You will know how many units you scale out or take profit at each level, and you'll begin to just know and won't have to use the position calculators as much, but in the beginning, they are an absolute must. Here on the Baby Pips position calculator, they pretty much both ask for the same information, but it's going to ask you, what currency your account is in, what the balance of your account is, what your risk percentage is. Is it 1%, 2%, 3%? Is it 10%? What is the risk percentage that you're willing to run, and what is your stop loss? Because you're calculating this as you're entering a trade. You want to know how many units to put in when you enter the trade. How many units are you buying or selling? The other thing that the babypips.com asks you for is the currency pair. And sometimes it will ask you what the price that currency pair is trading at that moment. And then if you click on calculate, it's going to give you all of this information over here, and it's going to tell you, how much of the amount is at risk of, depending on the percentage that you got here in your account balance. It's going to say, what is your position size here? It's just like our example. It's 100,000 pips. It's one lot. It's 10 mini lots and 100 micro lots. And these are just measurements of what the lot sizes are. It's just calculating them for you, basically. The TradingView has a built-in position calculator as well. This is the one that I use because we trade through TradingView for the most part. Sometimes I'll trade on my phone or my tablet and use MT4 or MT5. We have both of those as well. And we have another account on another platform that I use sometimes, but the majority of my trades are placed through TradingView. It's just so easy when we're trading for a couple hours here in the morning in the office together. And so TradingView has where you have the number of units that you enter right here. It has the risk of what your risk is, your percentage here. It has your risk to reward ratio right here, what your stop loss is. And you see it right here, entered in as 10 pips. And, your trade is the $100. And so you kind of see it's giving you all the numbers in the breakdown. So it's not exactly the same as Baby Pips on the position size calculator. And so that's why I usually send people here, but TradingView has it too. And like I said, this is the one that I use, my son uses, and my husband uses, if we don't already just memorize, exactly how many units that we enter in on each trade, which, like I said, you're going to get used to that pretty quickly and just know. But go here, don't even waste your time, just let it figure out depending on which pair you're trading, and just go ahead and bookmark your browser and at the beginning of your trading day, pull up your position size calculator, or go ahead and calculate what your entry position size would be before you ever enter a trade. And just to show you how the babypips.com position size calculator works, again, very simple. You come in with your account currency here showing US dollars, what your account balance is. We're going to use 10,000 just like in our example. Our risk percentage is 1%. If we're entering a trade right now, I'm going to say, oh, my stop loss is 10 pips and we're on the euro dollar. And if you just click calculate right here, it again comes in for the amount of risk here is $100 is what I'm saying. Okay, 1% of my account, of my $10,000 account, I'm spending $100 on this trade, and that gives me what my position size is. Like if my stop loss was 20 pips instead of 10 pips, and you change that to say calculate, it's going to now say that my position size is 50,000 units instead of 100,000 units. And so depending on, you know, what your stop loss is, it's going to calculate what this position size is. And again, most of the time you're going to, just depending on what your strategy is, you know, you're going to kind of have an idea of what that size is. And so you're going to kind of know what to enter there. But if not, you just pull this up on your screen or on your phone. You really quickly, when you see a trade set up that you might get triggered into, you just do your calculations, you know, real fast, run them through and know what your position size is. We've already talked about the amounts you might would scale out. And so if your position size is 55K and you're scaling out, you know, 50%, you might round it up and say, okay, well, I'm now gonna, you know, when I close it out 55%, I'm gonna, you know, close out 27,000 of a position size, you know, 50% of that, or you might do exactly 50%. I kind of tend to round mine up or down. I don't really overthink that or get it exact. But anyway, that's how the baby pips calculator and position size calculator works. It's very, very simple, you know, to do. It is something that you're going to have to do for each trade, and something that you're going to have to establish in your trading plan, how much money you're willing to risk on each trade.